Yes, I agree. Canada has a lot of taxes. But Canada also lets me save and grow my money. All tax free. My investment goal is simple. I want to save as much of my money as possible, invest it in Canadian and US companies, and watch it grow. So I attended a few library events, spoke to financial advisors, went to discussion groups, both offline and online, and I've realized to save and grow money in Canada, you need to know two things: registered savings accounts and the stock market. In this video, I'm going to be combining them and show you the exact steps I took to start investing. So if you're a complete beginner, have no clue where to begin, but if you care about your loonies, then this is the video you've been waiting for. Because today we are going to see what is income tax and why does it matter, what are registered savings accounts, and how to pick the right one for you. Top 6 investment options available in Canada, stock market for beginners. How do I pick which stocks to buy for both Canadian and US markets? What my portfolio looks like today. And in the end, I'll give you a bonus tip to help you understand what not to do if you're new to the stock market, so that you don't lose all of your money on the first day. And if that can really happen. It is going to be a long video, so make sure you save it and add it to a playlist. And feel free to use these timestamps to skip right ahead if you're already familiar with some of the topics. Like, for example, if you're interested in the stock market, then you can directly jump to this section. But if you're a complete beginner, I promise by the end of this video, you will know exactly how to grow your money. And if you like this video, please hit that like button because it tells us that we should keep making more videos. So without further ado, let's begin. I'm going to keep this one short because to understand Canada, you need to understand income tax. It's the money you pay to the government based on your earnings. And the government uses this money to fund healthcare, education, and infrastructure. But here's the catch. It is collected by both federal and provincial governments. For example, here are the federal tax rates. And let's assume you're staying in beautiful British Columbia. So the tax rates applicable to you will be this. To understand this, let's assume your taxable income is $100,000. Just because it's an easy number. Let's first calculate the federal government tax. You'll pay 15% on the first $55,867 of your income, and that gives us around $8,000. Your income above this amount falls into the next bracket, which is taxed at 20.5%. To get that portion, we need to subtract 100,000 with this number. It gives us around 44K. Now we apply the tax rate of 20.5% on this number, and it gives us around $9,000. So technically, the more money you make, the higher percentage of tax you need to pay for that extra amount. So 9,000 from the second bracket and 8,000 from the first bracket adds to approximately $17,000. This is the tax you owe to the federal government. We're not done yet. Let's move on to the provincial tax. These are British Columbia's tax rates. Let's calculate this quickly. 5.06% gets applied to the first $47,000 of your income, and that gives us around $2,400. Now, to find the portion of your income that falls in this bracket, we need to subtract the lower limit from the upper limit, giving us around $47,000. So 7.7% of this portion gives us approximately $3,600. Now, your remaining income above $95,000 falls into the third bracket, and we apply a percentage of 10.5% on it, which gives us around $433. Adding all these brackets together, you owe the provincial government around $6,500. Let's add federal and provincial tax, and the total tax you owe is about $24,000, which means you owe around 24% of your income to taxes. This can be a lot. But thankfully, Canada offers various tax saving options, and one of them are registered savings accounts. They help you save money and reduce the amount of tax you owe, depending upon the account you choose. Now that you've understood why we need it, let's understand the what. What are registered savings accounts? If you know about these already and want to skip right ahead to the stock market section, then you can directly jump to this timestamp. So what are registered savings accounts? When you go to a bank and open a regular savings account with them, you're most probably opening a non-registered savings account. It's like a normal account where any profit you make, be it through interest or capital gains, will be considered taxable income. We will understand capital gains in just a moment. But registered savings accounts are special accounts recognized by the government. If you deposit and save money in these accounts, you will receive tax benefits. But that money doesn't just have to sit idle. When you invest this money in GICs, mutual funds, stocks, ETFs, or bonds, then the growth of your money will also have certain tax benefits. We'll understand all these investment options in a minute too. For now, here are the three terms we must understand before we dive into the accounts. Tax deductible, tax deferred, tax-free growth and withdrawal. I think of them as three superpowers: a tax shield, a tax time traveling machine, and an invisibility cloak. Let me explain what I mean. Tax deductible means that you can subtract the money you contribute to a registered savings account from your taxable income. For example, if you earn $70,000 and contribute, say, $10,000 to your RRSP registered savings account, we will discuss RRSP in just a minute. Your taxable income drops to $60,000. This means instead of $70,000, you only need to pay taxes on $60,000. It's like having a shield that reduces the impact. You will still face taxes, but the shield protects part of your income, so you end up paying less. Next, we have tax deferred. It means you delay paying taxes to a later date. It's like using a time machine. When you put money into a time machine like RRSP, it travels through time and grows tax-free. But when you withdraw it years later, you pay taxes on it. This works well because in retirement, your income is often lower than your working years. So you'll pay taxes at a lower rate when you withdraw them. And finally, we have tax-free growth and withdrawal. It means when you withdraw your growth, you keep every dollar. For example, if you invest $10,000 in a TFSA account and it grows to, say, $20,000, then you can withdraw $20,000 tax-free. Just like Harry wearing an invisibility cloak, no one can see your money. It becomes invisible to taxes. I know this has gotten you all excited, so let's see the super accounts that give us these powers. First is everybody's favorite, TFSA. It stands for Tax-Free Savings Account. Contributions to TFSA are not tax deductible, which means it won't reduce your taxable income immediately, but all your withdrawals will be tax-free. You can use it for anything: travel, education, retirement, but how much you contribute every year depends on the annual limit set by the Canadian government. For example, you could have saved $6,500 in 2023. You can get this list by visiting canada.ca. And if you're not able to save the complete amount in a year, any unused room gets carried forward to next year. For example, let's say in 2023, you could only save $2,000. Now the remaining room of $4,500 gets carried forward to 2024, which means in 2024, your contribution limit would be $11,500. The best part is that if you withdraw money, you don't lose that contribution room. It gets added back the following year. However, there are rules to follow. Over-contributing can lead to penalties on the extra amount, so it's crucial to check the CRA website to know about your contribution room. The flexibility and tax-free withdrawals make TFSA an absolute favorite. If you want to see the step-by-step process of how I open my TFSA account and use it to grow my money, then you can watch this video by clicking right here. I've also left its link in the description. Next, we have RRSP, Registered Retirement Savings Plan. It's an account to encourage us to save for retirement. Contributions are tax deductible, but growth is tax deferred. The goal is to withdraw funds during retirement when your taxable income is likely lower, allowing you to pay less in taxes overall. Contribution limit is 18% of your income to an annual maximum set by the government. If you withdraw from your RRSP before retirement, then you have to pay a withholding tax, and that withdrawal amount will also be added to your taxable income. And withdrawing from an RRSP permanently reduces your contribution room. But wait, there are two exceptions: Home Buyers Plan and Lifelong Learning Plan. These allow you to withdraw from RRSP tax-free with a condition that repayment to your RRSP must be made. We'll talk more about HBP. Next, we have FHSA, First Home Savings Account. It's tax deductible. Growth is tax deferred and withdrawals are tax-free. I know, right? This is what dreams are made of. Dreams of 30-plus-year-olds, but you can open an FHSA only if you qualify as a first-time home buyer. So visit the CRA website to find out if you're eligible. You can save up to $8,000 per year to a lifetime maximum of $40,000. And if you invest that amount and it grows to, say, $50,000, then you can withdraw the entire $50,000 tax-free as long as you're using the funds for a qualifying home purchase. But wait, I'm not done. Here's something that will blow your mind. You can combine your FHSA amount with Home Buyers Plan amount. HBP allows you to withdraw up to $60,000 from your RRSP tax-free. But there are some rules around repaying it back to your RRSP. Let me break it down for you. If you plan well, you can combine $40,000 from your FHSA plus any investment growth, with $60,000 from your RRSP using home buyers plan. Add to that your spouse's FHSA and their RRSP and get that substantial down payment on your dream house. All tax-free. I mean, what? So if your goal is to buy a house, read about the conditions you need to meet on the CRA official website about FHSA and HBP and start planning. And if you'd like me to make a detailed video about it, including the step-by-step process of opening an FHSA account, then let me know in the comments below. And the last account of the day is RESP, Registered Education Savings Plan. If you have kids and dream of sending them to college, and RESP can help you save for their post-secondary education. If you're not interested in an RESP, then you can go to this minute and directly jump to the non-registered savings account section. And to my fellow parents, contributions to RESP are not tax deductible, and growth is tax deferred. But wait, it's taxed in the hands of the student. There is a lifetime contribution limit of $50,000 per child, and the government offers grants of up to $500 per year to a lifetime max of $7,200. And just like the rest of the registered savings accounts, you can invest your RESP money and watch it grow along with your child. So those were the 4 registered savings accounts. We also have accounts like RDSP and RRIF. If you'd like me to create a separate video diving into those, let me know in the comments. So each registered savings account is tailored for a specific life goal. On the other hand, we have non-registered savings accounts. They offer no tax benefits, but they provide flexibility because they have no withdrawal rules and no contribution limits. It's just like a plain regular account. This table is just meant to spark your interest. For more details, visit CRA's official website. In fact, whenever I had questions about my contribution limits or eligibility, I called their helpline and they provided all the clarifications I needed. Now this brings us to the question, how do I decide how much to contribute in what account? I personally max out my TFSA first and then contribute to my RRSP. But once I open my FHSA and RESP accounts, I will prioritize them over my RRSP. I think it all depends on individual goals and income. For example, someone with high income might contribute to their RRSP first to reduce their taxable income right away. Parents might focus on TFSA and RESP because most of us want our kids to go to college. And a student or someone who wants to buy a house might prioritize their TFSA and FHSA. Oh my God, you are still here? You are serious about your loonies, aren't you? Now that we've covered what are registered savings accounts, let's move on to the fun part, the how. How to invest using these registered savings accounts. But before that, comment and tell me which account you'd like to open first. Is it TFSA, FHSA or RESP? It'll just help me decide what kind of detailed videos to make for you next. As I mentioned earlier, the money in your registered savings accounts doesn't have to sit idle. You can invest it and let it grow. Here are the top 6 investment options I considered when I began my investment journey. Let's go through them quickly. HISA just offers higher interest rates than regular saving accounts. Some banks even have promotional offers like this one, where they might offer a slightly higher rate for a few months. I wouldn't lie, not my cup of tea. GIC is a lower risk investment option in which both the initial amount and a typical annual rate of return is also guaranteed. These are the GIC interest rates that my bank was offering me. Personally, I keep a few months worth of my expenses, aka my emergency fund, in a GIC as a non-registered savings account. My priority is keeping this money safe, and with the GIC, I prioritize stability over growth. Bonds are loans you provide to governments or corporations in exchange for regular interest payments. They are generally less risky than stocks but offer lower returns. I personally think they are good options for investors looking for stability and low risk. We'll talk more about this in the next section. Stocks, also called as shares, represent ownership in a company. They can provide higher returns, but they come with high risk as well, which means both your principal amount and the interest rate are not guaranteed. But there are ways to reduce your risk. I'll show you how in just a minute. Next are mutual funds. Fund managers make a pool of money from multiple investors like you and me and use this money to invest in different stocks, bonds, etc. They come with fees called management expense ratio, which in Canada is at an average of 2%, one of the highest in the world. I'll tell you why I personally do not prefer high MERs when I show you the calculation of how much they can cost you in the next section. And that brings us to ETFs, exchange traded funds. They are like a basket that provides diversity by investing in multiple stocks, bonds. And their MERs, management expense ratio, especially of index ETFs, can be as low as 0.03%. I'll show you why I'm crazy about index ETFs and what I look for them before I invest in the next section. Apart from these six, there are other investment options as well, like real estate, commodities, crypto. But to keep things simple, let's not talk about them today. Finally, we have reached the part you've come to this video for, the stock market. You can go grab that coffee now. Things are about to get real. To understand the stock market, we first need to understand a few stock market terms. Term 1, share. A share is a unit which represents ownership of a company. For example, when you buy shares of, say, Microsoft or Apple or Costco, you become a part owner of it. This can be both great and risky. Great because when tomorrow the company performs well and its share price rises, then you will make more money. Let's assume the price of one share of Apple right now is $100. It's not. For simplicity, let's assume that it is. You decide that you want 10 shares of Apple. So you pay $1,000 and in return you get 10 shares. Let's assume after a few months, because of some profits Apple made or some good news in the economy, the price of Apple shares increases from $100 to $150, which means even though you invested $1,000 initially, now your 10 shares are worth 10 into 150, $1,500, which is great because the company is performing and you are getting paid. It's also risky because in case Apple or the economy doesn't do well and its share price decreases from 100 to say $90, then now your shares are worth 10 into 90, $900. So when you buy shares of a company, you not only share its goodwill, but also its risk. I'm going to show you how I minimize my risk by investing long-term in large and stable companies at this minute. Term 2, stock exchange. It's like a grocery store. Just like we visit a grocery store to buy essentials, people visit the stock exchange to buy and sell shares of companies. In Canada, we have the Toronto Stock Exchange, which lists over 1,500 companies like RBC, TD, Shopify. The US has exchanges like the New York Stock Exchange or NASDAQ, which lists some of their largest companies like Apple, Amazon, Walmart. But remember, you cannot physically visit a stock exchange to make a purchase. You can do it from your computer or mobile phone through platforms called brokers. We'll discuss brokers in a minute. Term 3, index. This is important. There are around 1,500 companies listed on the Toronto Stock Exchange and around 3,000 listed on the New York Stock Exchange. So if I ask you, how is the stock market moving today? You cannot check the share prices of every company now, can you? You will check a few key companies across sectors. If most are rising, the stock market is up. If most are falling, it's down. These key companies form the stock market index. In Canada, the TSX 60 is an index that consists of top 60 companies listed on the Toronto Stock Exchange. And the S&P 500 is an index that represents the top 500 companies listed on the US Stock Exchange. But why do we need an index? Because it acts as a benchmark to measure any trading or investing activity. To understand this simply, let's assume you invested $10,000 and made a profit of $1,000 last year. You now have $11,000, a 10% return, which is great. But what if during the same year, the index, which is the top companies, made a return of 20%? Your 10% doesn't look so great now, does it? Because you've underperformed the market. So an index is a benchmark of performance for every investor because the objective of most fund managers and financial advisors is to outperform the index. But for people like me, life can be great if we just follow the index, which is why we have term 4, ETFs. An exchange-traded fund is like a basket that holds a collection of stocks, bonds, allowing investors like me to diversify their portfolio with just one ETF. My personal favorites are index ETFs. They have low management fees because they just buy and hold the same companies as the index they track. For example, these are some ETFs that track the Canadian index TSX 60, and these are some ETFs that track the S&P 500. We are going to talk about them in detail. For now, just remember that index ETFs are low-cost ways of diversifying your portfolio and reap the benefit of a growing Canadian or US market. Term 5, broker. As we earlier discussed, to buy or sell companies on the stock exchange, we need a platform called the broker. Think of them as your stock market besties because they help you set up your account, which holds the stocks and ETFs you buy, provide you with a trading terminal so that you can check on your portfolio, and they can give you tools or educational material to make you a better investor. And for all this, they charge some fee called the brokerage. Canada has multiple brokers like Wealthsimple, Interactive Brokers, QuesTrade, or even your bank. The broker you choose can depend on factors like what registered saving accounts they allow you to open, what investment options they provide. For example, some banks let you invest in the stock market through mutual funds and not ETFs, and how much brokerage they charge for buying, selling, and converting your currency. For me personally, what was important was a broker's reputation and low currency conversion rates because I also like investing in the US markets. If you want to see the step-by-step process of how I open my brokerage account and use it to invest my TFSA money, then you can watch this video by clicking right here. Term 6, capital gains. They refer to the profit made from the sale of an asset like stocks, real estate, or other investments. They are essentially the difference between the amount you sell the asset for and what you originally paid for it. For example, you buy a stock for $50. Later, you sell the same stock for $75. So your capital gain is $25. Similarly, capital loss is when you sell an asset for less than what you paid for. And the last and final term of the day is the stock market. It's a broad term that includes all the exchanges, brokers, and platforms that help with stock transactions. Now, before you go any further, we need to talk about this. The stock market is notoriously volatile. Let me show you what I mean. Let's assume you would have invested $100 in S&P 500 from the year 2020 to 2023. Then you would have seen around 11% return every year, which is great. But if you scroll down and see the returns per month, you would notice how unpredictable they've been. While some months showed gains, others dropped to negative. I mean, look at 2020. COVID-19 caused panic and investors were selling their stocks, causing prices to fall. When investors like us feel hopeful, we buy stocks and the prices increase. But when we are worried, we sell, causing prices to go down. I would say our feelings about things like the economy, war, election results, immigration, or even the weather can be just as important as actual company performance or economic data in driving these stock prices. This is the performance chart of indexes in Canada and the US. As you can see, there have been significant ups and downs. But the common hope is that long term, the stock market indexes will move upwards. Like many such optimists, I also believe that if I choose the right ETFs and stay invested long enough, it will result in capital gains and better returns than most other investment assets out there. As long as we're clear on that, let me show you how I decide which ETF to buy. Before we begin, I want you to remember that you're not a chef, but you cook every day. You're not an automobile engineer. If you are, I'm sorry for this example. But even if you're not, you can drive on the same lines. Even if you're not a financial advisor, you can learn about money. So if this gets difficult, I want you to remember that you do everything else just fine. Hold on to that feeling because it might be a bumpy ride. Are you ready? Let's go. Taskeen, you showed me a bunch of ETFs today, so which one should I buy? That's an excellent question, which is why in this section I'm going to show you what do I look for in an ETF, how I use ETFs to invest in both Canada and the US. And finally, I'll show you the step-by-step process of how I buy an ETF. As stated in the disclaimer, I am not recommending buying any of the ETFs. All of these are for educational purposes. With that, here's a list that I've used to begin my research. You might have seen some of them already. The ones under green are listed on the Canadian exchange and these ones are listed on a US exchange. We will understand why that matters in a minute. A ticker symbol is a unique abbreviation used to identify a particular ETF on a stock exchange because listing that entire name would be tricky, right? In Canada, the largest ETF providers are these. And in the USA, the largest ETF providers are these, among others. To understand what I look for in ETF, just for this demo, and most probably because you might have heard of it already, let's pick up Vanguard S&P 500 ETF, VOO. To check its parameters, I'm going to use Yahoo Finance. You can use any platform you like. So in the search bar, I'll type in VOO, Yahoo Finance. And on this page, here are the parameters I look for. First is rate of return. I check its 1, 3, 5-year performance. For comparison, the rate of return of your GIC or high interest saving account in Canada can be anywhere between 3 to 5%. But even though the rate of return here looks pretty impressive, I want you to remember that stock market prices constantly fluctuate, which is why, as a long-term investor, I look at 5+ year returns. Next, I look for our dear old friend MER, Management Expense Ratio, which is the cost of managing this fund. It's not a one-time fee. It's charged annually. Let's understand why this is important. Let's assume you've invested $10,000 in an ETF with a rate of return of 8% and its expense ratio is 0.5%. This means the fund will charge 0.5% of your investment value each year. With that charge, this is how your $10,000 of investment might grow over a period of 10 years. I know, this doesn't make sense, but it will make sense when you compare your 0.5% with another expense ratio. To do that, let's go to this MER calculator. Let's assume you've invested $10,000 for say 10 years. Rate of return of that fund is 8%. One fund's MER is 0.5% and another fund's MER is 0.03%, like VO's that we just saw. According to this calculator, you'll be paying around $1,000 extra in management fees. But these are conservative numbers. Let's assume you've maxed out your TFSA and have $50,000 in it, and your ROR was 12%. Will you look at that? Now, what if your MER was 2? You will be paying $25,000 in management fees. This is personally why I do not like mutual funds, because their MERs can be north of 2%. And the longer you stay invested, the more it will cost you. I mean, come on. Now, this is me hypothetically comparing a mutual fund MER with an ETF MER. But even among ETFs, a simple 0.5 or 0.8% can cost you significantly, especially if two funds are almost the same in terms of performance, holdings, so on and so forth. On a side note, every financial advisor I've spoken to so far has told me that I could only invest in mutual funds through them. And this is why it was a red flag for me, because I do not like high MERs. So whenever you're comparing any type of funds to invest in, play around with an MER calculator. Key in your digits and see how much management fees can cost you. But a low MER is not the only thing that matters, which brings me to the third ETF parameter I check, holdings. This overview says that VOO tracks the performance of S&P 500. If you don't remember what S&P 500 is, you can go back to this minute for a quick refresher. Coming back, I'll scroll down to holdings. This is where I'll see top 10 holdings, sector-wise holdings. Holdings are important for me because they help me understand how to diversify my portfolio. So here are my 3 favorite ways to diversify and gain exposure. Number 1, different market cap. Market capitalization is the total value of a company's outstanding shares. For example, large cap companies are worth $10 billion or more, like Apple or Microsoft. They can provide stability, but their growth potential can be comparatively limited. Mid-cap companies offer a balance between growth potential and stability. And small-cap companies are riskier because they can provide significant returns if they succeed. Let me show you what I mean by comparing VOO with VTI. Both have the same expense ratio, but VOO tracks the large cap companies, whereas VTI also tracks mid, small and micro cap stocks. These ETFs are by Vanguard. Another ETF provider, Charles Schwab, offers alternatives like SCHX and SCHB. Let's search for SCHX. Instead of Yahoo Finance, I'm going to go to their official website. I'll go to Portfolio, check market cap and see that more than 74% of its holdings are in large cap. Let's look at SCHB. I'll go to holdings and I can see that it is providing me exposure to small cap companies as well. So depending on my risk appetite, I can choose which ETF I want to invest more in, large cap, mid cap or small cap. My second favorite way to diversify is asset allocation. ETFs don't have to be 100% stocks. They're ETFs that also combine stocks with bonds. We had discussed how bonds can provide more stability than stocks at this minute. You can go back in case you need a refresher. This table right here lists some ETFs with different asset allocation percentages, but I'm sure you'll find more ETFs by other providers. As I age, maybe I'll invest more in bonds and less in stocks because I might prioritize stability over growth. And my third favorite way to diversify is through international markets. Here are some ETFs that can provide me with a global exposure. Let's pick up XEF and go to its official website. It's by BlackRock and it says it lets me invest in Europe, Asia and Australia. Okay, nice. Here are a few ETFs I discovered that provide access to the US markets. I can also find ETFs that invest in emerging markets all over the world like India, China, Brazil. I'll show you exactly how I browse and discover ETFs in the next section. But let's address the elephant in the room. What caught my eye was that these two ETFs have lower MERs compared to the others. But all of them seem to track the S&P 500, at least based on their names. And that brings me to my fourth and final factor, exchange. Which stock exchange is the ETF listed on? I don't want to complicate this by talking about exchanges all over the world. To keep it simple, let's focus only on Canada and the US exchanges. In Canada, we have the Toronto Stock Exchange or TSX, and in USA, we have exchanges like NYSE or NASDAQ. So as an investor from Canada, here are the three things I usually do. Invest in Canadian ETFs listed on the Toronto Stock Exchange. Invest in US ETFs listed on the Toronto Stock Exchange. And invest in US ETFs listed on US exchanges. Is this giving you a headache already? I won't blame you. Take a deep breath. And as my 3-year-old says, focus. This is the interesting part. Level 1 is simple. Buy a Canadian ETF on a Canadian exchange. Here's a list I used to begin my research. Let's pick up XIU. To check its details, I'll go to its official website. Looks like it invests in large Canadian companies and replicates TSX 60, which is a list of top 60 Canadian companies. I can even visit holdings and see some of the companies. If you want to watch the step-by-step process of how I purchased XIU in my TFSA account as a demo of buying Canadian ETFs, then you can watch it by clicking on this video right here. I've also left its link in the description. Back to the list. It also includes ETFs that replicate the performance of the CABD Composite Index, which is an index that covers over 200 top-ranked Canadian stocks, not just 60, providing the market cap diversity we talked about earlier. Level 2 is if I want to look across the border and invest in US companies, but through ETFs that are listed on the Toronto Stock Exchange. Here's a list I used to begin my research. At first glance, the name suggests that these ETFs likely track the S&P 500 index, which is perfect for me since I like investing in indexes. However, as a Canadian investor investing in US companies, here are the challenges I can face. Currency risk, which is changes in the exchange rate between the Canadian dollar and US dollar. To reduce this risk, some ETFs use hedging and it can raise their management fees. Foreign withholding tax. When US stocks are held indirectly through a Canada-listed ETF, 15% of the dividend is withheld by the US government. Double taxation. Most ETFs I've seen directly hold US stocks, but some Canadian ETFs hold US ETFs instead of directly holding stocks. In this case, there may be double taxation, with taxes applied at both the US and Canadian ETF levels. To understand why 2 and 3 don't bother me, we need to understand what are dividends. Dividends are payments that companies make to their investors as a way of sharing their profits. It's usually a small amount and is paid quarterly. Not all companies pay it. Many reinvest profits back to the business instead. So the reason why FWT doesn't bother me is because I'm not into the stock market for dividends. I'm here for growth. So the 15% tax on dividends is a small amount and for me is okay. I intentionally choose ETFs with little to no dividends, especially tech-focused ones. I prefer the profits to be reinvested in the company, allowing me to benefit from growth and withdraw it when I need it. And finally, what registered savings account I hold my US investments in also decides whether FWT applies to me or not. And that brings me to level 3. Before that, if you want to watch a demo of how I purchase a Canadian listed ETF investing in US companies, then you can watch this video right here. Coming back for level 3, I can invest in US companies on the US exchange. Here's a list I used to begin my research. I know what you're thinking. Taskeen, those expense ratios look too good to be true. You are right. As a Canadian investor, the challenges I can face at this level are currency conversion cost. To buy ETFs listed on US exchanges, I need US dollars. So every time I convert my Canadian dollars to USD and back, I need to pay currency conversion fees to my broker. Foreign withholding tax, which is a 15% tax on dividends. But thanks to a tax treaty between the USA and Canada, it is possible to waive off the FWT if US listed ETFs are held under RRSP or RRIF accounts. And if they are held in my non-registered savings account, then I can reclaim it. Because of this extra layer of complexity, I make sure I check the latest withholding tax guide and also consult my tax advisor because these laws can keep changing. As I said earlier, I don't mind the FWT. My real issue is currency conversion costs. Most Canadian brokers charge a percentage for conversions, which can get expensive. the more money I need to convert, the more I end up paying the broker. This is one of the main reasons I chose a trustworthy broker that charges a flat fee, not a percentage. If you want to see how I convert my currency and use it to invest in ETFs on US exchange, then you can watch it by clicking on this video right here. Hey, you are still watching! I must say I'm impressed. Let me now show you how I use all these parameters to decide which ETFs to buy. Here's the step-by-step process of how I find my ETFs. Step 1. I log into my brokerage account. I go to Research, select Market Screener, and choose ETFs, which gives me a list to explore. From here, I can apply filters. For example, I can filter by market cap. If I want to invest in large companies over $1 billion, then I can move this needle accordingly. And if I'm open to more risk, I can adjust the filter to include smaller companies. Step 2. I review each ETF, read its brief overview on the official website, and shortlist 4 to 5 that catch my interest. Step 3. I dive into the details, MER, performance, holdings, tax implications. I read every parameter listed on their website. If you need a quick refresher on how I analyze some of the ETF parameters, feel free to rewatch the ETF section at this minute. And step 4, if I have to choose between two, I go to the search bar and type ETF1 versus ETF2, and I read the comments on various discussion forums. This helps me gather different perspectives before making a decision. It was because of these forums that I decided to open an account with Interactive Brokers. If you're interested in them too, then you can watch the step-by-step process of how I opened my TFSA, RRSP, and non-registered savings account with them. And that brings us to the final question: what are my favorite ETFs? I keep it simple. Currently, I have 5 favorite ETFs that focus on indexes along with some technology and semiconductor ETFs. I use the same across all my registered saving accounts. That's just my investment philosophy, and I'm sure I have a lot to learn. I first invested $100 and watched the market move. While in the background, I read discussion forums, attended meetups, spoke to financial advisors, learned from local library events. It was not easy to gather information, but now that I'm beginning to understand, I cannot help but admire how amazing all of these options truly are. So thank you, Canada, for helping me save and invest. Now it's time for you to find your investment philosophy. Before we move on to the bonus tip, if you've liked this video, make sure you subscribe and hit the bell icon, because we value your time and create videos that matter, that are well researched and to the point. I found this image on LinkedIn and realized how similar farming and long-term investing can be. Just like farming, it's about choosing the best plants and remembering that you will have good seasons and bad. So today's bonus tip is this: it takes time. Both Canadian and US stock markets have experienced challenging years throughout history, even as recently as 2022. So I choose the best ETFs, cross my fingers, and hope for the best. Does that make me delusional?
Of course I'm delusional!
It takes time. As they say, time in the stock market is better than timing the stock market. On that note, I am Taskeen, this is The Urban Fight, and I'm going to see you in the next video. You can find it right here.